Something strange is happening in the silver market right now, and almost no one is talking about it. While headlines in the West show silver trading calmly on paper exchanges, buyers on the other side of the world are paying prices that don't even look real anymore. In China, silver is quietly trading at levels that imply an $80 price, not because of speculation or hype, but because people are desperate to get their hands on physical metal. When two prices exist for the same asset at the same time, history tells us one thing very clearly. The system is under stress, and something eventually has to break. To understand why this matters, you need to zoom out for a moment. Silver isn't just another commodity. It sits at the intersection of money, industry, and trust. It's used in electronics, solar panels, electric vehicles, medical equipment, and advanced manufacturing, while at the same time being viewed as a store of value when currencies lose credibility. That dual role makes silver uniquely sensitive to economic pressure. When the world economy is stable, silver behaves like an industrial metal. When confidence cracks, it starts behaving like money again. What we are seeing now suggests that silver is being pulled in both directions at once. Officially, global silver prices are still set in Western paper markets, primarily through futures contracts traded in New York and London. These prices are supposed to reflect global supply and demand, but in reality, they increasingly reflect something else: leverage, derivatives, and promises to deliver silver at a later date. In contrast, the prices emerging in China are based on immediate physical demand. When a manufacturer, refiner, or investor in China wants silver, they want the metal now, not a paper claim. And they are willing to pay a premium to get it. That premium is the story. In normal markets, premiums exist, but they stay relatively small. Transportation costs, taxes, and local demand can explain minor differences. What's happening now goes far beyond that. The spread between Western spot prices and Chinese physical prices has widened to levels that signal stress in the supply chain. This isn't about speculation, it's about availability. Silver that should be flowing smoothly through global markets is suddenly hard to source where demand is strongest. China plays a central role in this story for a reason. It is one of the world's largest consumers of silver, not just for investment, but for industrial use. As China accelerates its push into renewable energy, electric vehicles, and advanced electronics, its need for silver keeps growing. Solar panels alone consume massive amounts of silver, and Beijing has made it clear that energy security and industrial self-sufficiency are national priorities. When China decides it needs more silver, it doesn't wait for Western markets to catch up. It goes directly into the physical market and pays whatever is necessary. At the same time, the global silver supply is not growing fast enough to meet this demand. Mining production has been relatively flat, and in some regions, declining. Many silver mines are actually byproducts of copper, lead, or zinc mining, meaning silver output depends on the economics of other metals. When those operations slow down, silver supply tightens whether the market wants it to or not. Recycling helps, but it cannot fill the gap when industrial demand accelerates suddenly. Here's where the problem becomes impossible to ignore. On paper, there's plenty of silver. Futures markets show large volumes available for delivery, and inventories appear sufficient at first glance. But paper silver and physical silver are not the same thing. A futures contract is a promise. Physical silver is a bar you can hold, ship, and use. When too many people try to convert promises into metal at the same time, the illusion of abundance disappears. What we are seeing in China suggests that this conversion is already underway. Buyers are not waiting for prices to rise in New York before acting. They are responding to real shortages, real delays, and real competition for supply. As premiums rise, it sends a signal through the system that the official price may no longer reflect reality. And once that signal becomes loud enough, it forces a response. Mainstream financial media has largely ignored this development. When silver is mentioned at all, it's usually framed as a minor commodity story, overshadowed by stocks, bonds, or cryptocurrencies. But history shows that major financial shifts often begin quietly in places most investors aren't watching. Before past commodity squeezes, there were always early warning signs: regional shortages, rising premiums, and a growing disconnect between paper prices and physical markets. This disconnect creates a chain reaction. As premiums rise in China, traders look for arbitrage opportunities, trying to move silver from lower-priced markets to higher-priced ones. But that process depends on actual metal being available to move. If inventories are thinner than reported, or if large holders are unwilling to sell, the arbitrage fails. Instead of prices converging, the gap widens. That's when pressure starts to build inside the paper market itself. Western exchanges rely on confidence. As long as market participants believe that contracts can be settled smoothly, the system holds. But if too many players begin to doubt whether physical delivery is truly available, behavior changes. Some rush to secure metal. Others demand higher premiums. Some step away entirely. The market becomes fragile, not because of panic, but because trust erodes piece by piece. China's pricing behavior is a reflection of that erosion. It's not making headlines, but it's sending a message. Silver is becoming harder to source at the margins, and those margins are expanding. The fact that buyers are effectively valuing silver near $80 tells us something fundamental. The real price of silver may already be much higher than what screens in New York suggest. This doesn't mean an explosion happens overnight. Market stress rarely works that way. Instead, it builds quietly through imbalances that compound over time. Every ounce that gets locked into industrial use is an ounce that can't easily return to the market. Every contract rolled forward instead of settled adds another layer of leverage. Eventually, a trigger appears, often unexpected, and forces the system to reconcile paper with reality. We are now approaching that phase. The premiums in China are not just numbers, they are symptoms. They point to a deeper issue in the global silver market, one rooted in years of underinvestment, growing industrial demand, and a financial system that treats physical commodities like abstract assets. When those forces collide, the outcome is rarely gentle. As this pressure continues to build, the question is no longer whether the silver market will react, but how and when. And the answer to that question may come much sooner than most investors are prepared for. In the next part, we'll look more closely at the data behind these premiums, how supply constraints are tightening globally, and why this setup looks uncomfortably similar to past market squeezes that caught everyone off guard. To understand how serious the situation really is, we need to look beneath the surface and examine what the data is quietly revealing. On paper, global silver inventories appear adequate. Exchange reports show millions of ounces sitting in vaults, supposedly ready to meet demand. But those numbers don't tell the full story. What matters is not how much silver exists somewhere in the system, but how much is actually available, unencumbered, and willing to move at current prices. And this is where the illusion begins to crack. In recent months, delivery times for physical silver in Asia have lengthened. Refiners and fabricators report delays, not because demand is weak, but because supply is inconsistent. When silver does become available, it often comes with conditions: higher premiums, longer contracts, or restricted quantities. These are classic signs of a tightening market. In a truly balanced system, metal flows smoothly, prices converge across regions, and premiums stay narrow. None of that is happening right now. The premium explosion in China didn't appear out of nowhere. It is the result of sustained buying pressure meeting limited supply. Industrial users cannot simply stop purchasing silver. Solar manufacturers, electronics producers, and battery suppliers operate on tight schedules. If they fail to secure raw materials, production slows, contracts are missed, and costs rise. When silver becomes scarce, these buyers don't negotiate, they pay up. That behavior alone is enough to push premiums higher, regardless of what futures markets are signaling. At the same time, investment demand has not disappeared. In fact, it has become more selective. Large buyers are increasingly focused on physical metal rather than paper exposure. They understand that in periods of stress, derivatives can underperform the asset they are meant to represent. This shift doesn't show up immediately in headline numbers, but it matters. When investors remove physical silver from circulation and store it long term, it reduces liquidity for everyone else. Now add another layer to the story: the structure of the paper silver market itself. Futures markets allow participants to control large amounts of silver with relatively little capital. This leverage works as long as most contracts are settled in cash, and only a small percentage result in physical delivery. But when demand for delivery increases, the system becomes vulnerable. It doesn't take everyone asking for metal to create a problem. It only takes enough participants to stress available inventories. History provides uncomfortable examples of how this dynamic plays out. In previous commodity squeezes, prices remained suppressed until they didn't. For long periods, markets appeared calm, even stable. Then, as physical shortages intensified, premiums rose, delivery failures increased, and confidence vanished almost overnight. The result was a rapid repricing that shocked both bulls and bears. Silver has been through versions of this cycle before, and the early stages always looked like what we are seeing now. What makes the current setup more dangerous is the global context. Governments around the world are running massive deficits. Central banks have expanded balance sheets to levels that would have seemed impossible a decade ago. Interest rates, while higher than recent years, are still struggling to contain inflationary pressure. In this environment, tangible assets regain importance. Silver, with its monetary history and industrial necessity, sits directly in the crosshairs. China understands this context well. Its strategy has consistently focused on securing critical resources before shortages become obvious. Whether it's energy, rare earths, or industrial metals, Beijing prefers to act early rather than react late. The rising silver premiums suggest that this strategy is now being applied more aggressively. China isn't signaling through speeches or policy announcements. It's signaling through prices, and prices tend to be brutally honest. As silver is pulled into long-term industrial use and strategic stockpiles, less remains available for the open market. This creates a feedback loop. Higher premiums encourage hoarding. Hoarding reduces supply. Reduced supply pushes premiums even higher. Meanwhile, paper prices struggle to respond because they are weighed down by speculative positioning and algorithmic trading that doesn't account for physical scarcity until it's impossible to ignore. Eventually, these two worlds collide. When paper prices remain disconnected from physical reality for too long, one of two things happens. Either physical prices collapse, restoring balance, or paper prices surge to catch up. Given the strength of industrial demand and the lack of meaningful new supply, the first option becomes increasingly unlikely. That leaves repricing as the path of least resistance. This is where the idea of a squeeze stops being theoretical. A squeeze occurs when buyers are forced to compete for a limited supply, driving prices higher not out of greed, but necessity. In silver's case, that competition spans continents. Industrial users, investors, refiners, and even governments are all drawing from the same finite pool. When pressure builds simultaneously across these groups, markets don't adjust smoothly, they snap. We are already seeing hints of that snap in the way contracts are being rolled forward, in the way delivery notices are handled, and in the growing reluctance of large holders to part with metal. These are subtle signals, but they are consistent. They suggest a market that is functioning, but only barely, supported by confidence rather than abundance. The most important takeaway is this: prices don't need to reflect reality until they suddenly do. For months, sometimes years, markets can suppress signals that contradict the dominant narrative. But physical commodities have limits. You cannot print more silver. You cannot create it with accounting entries. When demand meets scarcity, price becomes the only variable left to adjust. As pressure continues to build in China and other regions, the gap between paper silver and physical silver becomes harder to justify. Each new premium, each delayed delivery, each quiet shortage adds weight to the same conclusion. The current price structure is unstable, and unstable systems don't correct gently. In the final part, we'll explore what happens when this pressure reaches its breaking point. We'll look at the potential triggers that could force a rapid repricing, the consequences for global supply chains and investors, and why the next phase of the story may unfold faster than anyone expects. Every market reaches a moment where tension can no longer be contained. It isn't announced in advance, and it rarely arrives in a dramatic way at first. Instead, it begins with a small failure somewhere in the system, a missed delivery, an unexpected surge in demand, or a sudden withdrawal of supply. In the silver market, that moment is approaching, and the warning signs are already in place. One potential trigger is deceptively simple: a major buyer demanding physical delivery instead of rolling contracts forward. In normal conditions, this request would be routine, but in a tight market, it forces exchanges and counterparties to reveal whether the metal is truly there. If delivery is delayed, substituted, or settled in cash, confidence takes a hit. When confidence weakens, others follow. What starts as one request quickly becomes many, and the system finds itself under strain. Another trigger could come from the industrial side. A surge in demand from the renewable energy sector, electronics manufacturing, or electric vehicle production doesn't need to be extreme to cause disruption. When inventories are already thin, even a modest increase can tip the balance. Factories can't pause and wait for markets to stabilize. They must secure supply immediately, even if it means paying prices that seem irrational by paper market standards. Geopolitical risk adds yet another layer of instability. Trade restrictions, sanctions, or disruptions in mining regions can remove supply from the market overnight. Silver production is geographically concentrated, and any interruption reverberates quickly through the system. In an environment where supply chains are already fragile, shocks don't get absorbed, they get amplified. When the breaking point arrives, the repricing of silver is unlikely to be smooth. Markets that have suppressed volatility tend to overcorrect. Prices gap higher, liquidity thins out, and participants scramble to reassess risk. In such moments, traditional models fail because they are built on assumptions that no longer hold. The idea that silver can always be sourced at a predictable price breaks down, and the market is forced to confront reality in real time. For investors, this creates both opportunity and danger. Sudden moves reward those positioned early, but punish those relying on leverage or complacency. For industrial users, it means higher costs and potential disruptions. For governments, it raises uncomfortable questions about resource security and economic resilience. Silver may be a small market compared to oil or gold, but its role in modern technology gives it outsized importance. The broader implication is not just about price. It's about trust in the mechanisms that set prices in the first place. If the silver market is forced to reconcile paper claims with physical scarcity, it sets a precedent. Other commodities with similar structures may face the same scrutiny. The repricing of silver could become a signal, a warning that the era of endless leverage and abstract valuation is reaching its limits. Best case scenarios involve a controlled adjustment. Prices rise steadily, supply responds over time, and markets find a new equilibrium. But history suggests that best case outcomes are rare when imbalances grow unchecked. More often, the adjustment is abrupt, driven by urgency rather than planning. Worst-case scenarios involve cascading failures, delivery defaults, forced liquidations, and policy interventions that attempt to restore order after the fact. What makes this moment different is how quietly it has developed. There are no headlines screaming crisis, no official acknowledgments of shortage. Yet beneath the surface, the signals are unmistakable. Premiums exploding in China, tightening supply chains, and a growing disconnect between paper and physical markets all point in the same direction. The system is under pressure, and pressure demands release. Silver has a long history of exposing weaknesses in financial structures. It has done so during periods of inflation, monetary expansion, and industrial transformation. Each time, the lesson has been the same. When trust erodes, tangible assets reassert their value. The current environment, defined by debt, geopolitical uncertainty, and technological change, is fertile ground for that lesson to repeat. The question is not whether silver will matter again, but whether most people will recognize what's happening before the adjustment is complete. By the time prices reflect the full reality of scarcity, the opportunity to prepare has often passed. Markets move first, explanations come later. What we are witnessing now in China may be the early chapter of a much larger story. A story about supply and demand, about confidence and constraint, and about the limits of financial engineering in a physical world. When silver finally forces that story into the open, it won't ask for permission and it won't wait for consensus. And when that moment arrives, many will look back at today's quiet premiums and wonder how something so obvious managed to go unnoticed for so long.